This is as of this morning. If it wasn't clear that they are panicking, that they are feeling pressure, that they are worried, and that they're trying to send a message, as of this morning, CNBC hit the wire. Bessent could tap nearly $1 trillion of the Treasury General Account to fund bond buybacks, sources said. Here's the thing, guys. At the end of the day, they have to, I've been saying it, I was going to say for months, but this is for a decade plus now. They have to make the currency weaker. They have to print the money. So things like Bitcoin have to go up. Have to.
There is a very unusual thing happening in the Treasury market right now. The United States government is effectively moving toward using its own balance sheet to support the bond market, and Bitcoin is responding massively. The first announcement that the Treasury would double its purchases of longer-dated government bonds helped trigger a dramatic shift in yields and risk appetite. And Bitcoin responded with one of its most violent rallies in years. In just 3 days, Bitcoin surged more than 20%, its strongest 3-day move since 2023, while more than $4 billion in bearish crypto positions were liquidated. Now Bitcoin is pushing toward $81,000 and the market has just been given another reason to believe that the liquidity impulse could become substantially larger. While most of the market is focused on the headline that Scott Bessent could potentially tap nearly $1 trillion sitting in the Treasury General Account to fund additional bond buybacks, Strike CEO Jack Mallers is looking past the headline and toward what this actually means for the structure of the financial system. His argument is that the details of how the Treasury executes these purchases may be complicated, and the government may go to great lengths to avoid calling this quantitative easing. But the economic direction is remarkably simple: more support for longer duration bonds, more liquidity flowing back toward the private sector, downward pressure on yields, and ultimately a weaker monetary environment, which will undoubtedly be super bullish for Bitcoin. In this video, we're going to break down exactly what Bessent is proposing, why Mallers considers the mechanics almost irrelevant compared with the ultimate monetary effect, how the Treasury General Account could be used to support the bond market, and why rising yields, the U.S. debt burden, and the changing structure of government financing could ultimately create an increasingly powerful environment for scarce assets like Bitcoin. If you think this analysis is important, hit the like button and turn on post notifications so you don't miss the next update as these liquidity developments continue to unfold.
Why Bitcoin is ripping. The bond market may have forced Washington's hand. Okay, here we go. What the U.S. Treasury just did. So this on the left is Treasury announces increased sizes of nominal long-end liquidity support buybacks beginning September 9th. Okay, so to be clear, the Treasury actually hasn't purchased anything yet. They announced that they've doubled the program and their next opportunity would be September 9th, which is still some weeks away. However, on the right, what you guys are looking at is in the white, that's Bitcoin's price. In the blue is gold's price. And in the green is the dollar index, okay? And you can tell the performance that I put on the bottom left of the screen. At this one very moment when the U.S. Treasury made this announcement on August 19th, 2026, Bitcoin ripped 25.2%, gold ripped 6.1%, and the dollar index fell 60 basis points, all at the same second. Let me zoom in so you guys can see. Oh, shoot. Here we go. Not a professional podcaster. Let me zoom in. You guys see literally at the same second. This is not a coincidence. Why did Bitcoin rip? I mean, you cannot really justify anything else. Now, it's never as simple as just one thing. There's all sorts of stuff going on. Markets are complicated, and we'll get into all of it. But when you look at this chart, you see gold and Bitcoin move at the same time and the dollar fall. The dollar weakened immediately after this announcement. So it is very obvious that hard assets repriced on this announcement and the dollar weakened on this announcement. So what the hell happened? I call it number go up yields edition. Here's what we're looking at on this slide. This is the 10-year U.S. Treasury yield in white and the 30-year U.S. Treasury yield in blue. To make a very long story short, and I'm going to try and keep this episode as simple as I possibly can, because if you guys want to learn like with the Harvard economists, you guys can go sign up for a university course. This is a show by the common man for the common man, okay? So when we look at the 10-year yield and the 30-year yield, this is how simple I'll keep it. The U.S. government does not want those numbers to go up, okay? Those numbers going up means it's more expensive for them to borrow money. And we know that the U.S. government has to borrow money because it runs deficits, meaning it spends more money than it earns, and it accumulates more debt with time. That is a structural decision that has come with being the world reserve currency. That is the U.S. dollar in this post-World War II, post-1971 monetary policy, this latest iteration of the dollar, so on and so forth, so on and so forth. And so this is the problem that they're reacting to. So first, the initial announcement, and this is a screenshot from CNBC, is the Treasury doubled their debt buyback as Bessent moves to steady the bond market. So clearly, the U.S. government was worried about the bond market. And again, they were worried about the rising yields. And I'll explain all of this. If you don't know what I'm talking about, I'll explain it in a second, so just bear with me. But when the yield goes up, that's bad for the government. It's more expensive for the government to finance itself, and they were panicking and reacting to a dysfunctional bond market. Those yields kept going higher. And so what was the actual announcement? The previous max of purchase buybacks were $2 billion. Now it is doubled to at least $4 billion. And this is very specifically for what is called long duration. What is long duration? Specifically in this announcement, it's 10 to 20 year and 20 to 30 year treasuries, okay? Now bear with me. This is as of this morning. If it wasn't clear that they are panicking, that they are feeling pressure, that they are worried, and that they're trying to send a message, as of this morning, CNBC hit the wire. Bessent could tap nearly $1 trillion of the Treasury General Account to fund bond buybacks, sources said. I wonder what source leaked that right before markets opened on Monday morning. It couldn't have been Scott Bessent himself. Maybe he put on one of those fool me once masks. He walked into CNBC's office with a Halloween costume on and said, hey, sources told me I could spend up to $1 trillion on bonds. But this is obviously orders of magnitude larger of a threat. He's putting $1 trillion on the table and saying, I will erase the long end off the market if I have to. Now, why is he keep hitting the market with headlines? And with, again, he hasn't bought anything yet. Markets are forward-looking, okay, right? Markets are... Once these announcements hit the wire and the government and Scott Bessent, which, by the way, just to remind everyone, you can think of Scott Bessent, so when I say this Bessent name, he's like the CFO of the United States of America. Technically, he's the Treasury Secretary, but you can think of him, he manages the United States finances. So when it comes to, we need to finance all these wars, we need to finance all these deficits, we need to find ways to borrow more money despite all of the geopolitical drama and the macroeconomic backdrop and the this and the that and what's going on in Congress, it's his job to pay the bills and manage the finances. So the reason he's panicking and he continues to issue these statements is because if you look, I took these screenshots right before the show. So this is the 10-year yield. Yeah, it's down, but barely. That's down 4 basis points since his announcement. So it was at 4.7, and now it's at 4.69. Or yeah, I mean, okay. And same with the 30-year. The 30-year went from 5.26 to 5.22. So the point is, the markets didn't really, the yield number is still going up. We've got ourselves, ladies and gentlemen, a sovereign debt crisis brewing. And Scott Bessent knows it. The U.S. government knows it. The market knows it.
Whether the Treasury finances these purchases through short-term bills, spends down the TGA and later replenishes it, or structures the operation in another way, the important question is what happens to liquidity, reserves, yields, and the government's ability to carry an enormous debt burden at higher interest rates. And if the answer is that policymakers increasingly need easier financial conditions to keep that system functioning, then the implications extend far beyond the Treasury market. That brings us directly to the second part of Mahler's argument, because once you understand why the Treasury would want to buy longer duration bonds in the first place, the next question becomes how the government can actually finance those purchases without creating an even bigger problem elsewhere. This is where the Treasury General Account, short-term Treasury bills, and the concept of effectively shortening the maturity of government debt become extremely important.
Another way that this can be financed, and this is what Bessent came out this morning and he told CNBC, or I guess a source close to him told CNBC, Scott Bessent in a Halloween costume told CNBC that, so the Treasury has a bank account at the Fed, just like everyone else, okay? Their balance is about $1 trillion. I looked it up. It's about $950 billion, okay? This is called the TGA, the Treasury General's Account. Now, what he's saying is I can use that money to buy these long duration, which is basically saying, well, I might not have to issue a bunch of 3 months to buy 30 years. Sorry, I apologize. This is so confusing. It's really unnecessary. But he's saying I have $1 trillion in the bank. I could spend that. Now, the problem, and this is why it's not really, if you're a Bitcoiner, it's really not worth your time because it's all such a giant joke and nonsense. If the Treasury of the U.S. government cannot have a low bank balance. They need money to like roll over debt to finance things. I mean, remember when the government shut down last October? Like if the Treasury didn't have any money in its bank account, then like payments would have just stopped. So you cannot, like, it's all a bluff. It's all a bluff. Okay, fine, Scott. You can spend down your TGA. Fine. But then you have to refill it. So if you spend the $900 billion from the TGA and look me in the eye and say, I didn't issue any T-bills to finance that, but then you refill the TGA by raising money with 3-month bills, then you did the same thing just in a sneakier way. And that's really all this is it's political warfare. It's deceptive tactics, because here's the thing, guys. At the end of the day, they have to, I've been saying it, I was going to say for months, but this is for a decade plus now. They have to make the currency weaker. They have to print the money. So things like Bitcoin have to go up. Have to. I'm sorry to speak in definitives. I know that pisses people off. Sue me. I've been right for almost 14 years, and I plan to be right for the next 40 years. Okay? Until I'm wrong, I'm going to be as confident as I've always been. That's just the way it is. Now, the detail is all about making it confusing and tricking. This is all some variant of quantitative easing. This is all some variant of money printing. This is all easier monetary policy. This is all weaker dollar. I pulled up the chart. As soon as Bitcoin exploded is when the dollar started to get weaker. It's just so simple. But if you want to follow the ins and outs and stuff, that's where you're confused yourself. So the details don't matter. If you want to know, yes, he can use his bank account. He can issue 3-month paper, raise cash that way to pay off 30-year paper. Sure. He could also spend down his bank account, and then when his bank account hits zero, he could refill it by issuing 3-month paper. What's the difference? There is no difference, okay? So anyway, this slide basically just says as much. The Treasury General Account balance will go down. Private sector deposits and reserves will go up. It's all a waste of time. Okay. Again, I just want to be clear. Technically, this is not QE. They're not calling it QE. I'd be shocked if they ever call it QE. QE stands for quantitative easing. It's effectively money printing, and quantitative easing is when the Federal Reserve, the central bank themselves, creates reserves, and the central banks themselves buys bonds. And that would be quite literally printing money out of thin air and lending it to the U.S. government. Okay. This is not quite that, because it is the U.S. government itself financing or using existing cash to buy bonds. But it's a very similar direction. And the point that was made to the market is abundantly clear. And let me say, why is Scott Bessent doing this now? Well, there's a lot of reasons. First of all, this war in Iran, like, I mean, just couldn't have been poorer timed, bigger miscalculation. It just was a bad strategic move. I mean, all of this was playing out kind of slowly until, I mean, if I go back, hold on, let me go back. If you guys see here on the screen, let me zoom into the 10-year here. Do you see the low here on the screen? So this is the 10-year yield year to date. The low was the end of February. When was that? Right when the Iran conflict started. And since then, yields have been on a tear. So you can't sit here and tell me that that was like a great idea. And I know, I hate getting into politics. I know we can't let them get nuclear weapons, and I'm not in the decision rooms. So I have no place to comment and tell people what to do. But what I can tell you definitively, just looking at charts, is the yields have been on a tear. Like, so whatever slow, painful process of the United States facing a debt spiral, which I've been talking about for years now, I mean, clearly this conflict was exaggerated it greatly. So anyways, so this tweet from Peter Schiff, I jokingly crossed out the end, but let me read it because before he arrives at the conclusion that you need to own gold, he makes very good points. It's my boy, Peter Schiff. He writes, Bessent's plan to use the TGA, so as we said, Treasury General Account, to fund Treasury buybacks makes possible exactly what I warned would happen. This reckless plan will substantially shorten the average maturity of the national debt, increasing our exposure to rising short-term rates and making it even harder for the Fed to hike rates without exploding federal interest expense and budget deficits. It's a recipe for massive QE and runaway inflation. He wrote, got gold. I crossed it out, and I said, got Bitcoin. Now, his points, though, and now we have a difference of opinion on what you should own, but his points are very good, okay? He's saying the average maturity of the national debt is now going to be greatly shortened because we're effectively financing the U.S. government on these like 90-day rolling loans as opposed to 10-year, 30-year. Let me tell you guys, if I can give you a 90-day mortgage or a 30-year mortgage, which one would you prefer? Hey, hell, if instead of a 30-year mortgage, what if I offered you a 300-year mortgage? Of course you want the longer duration. Of course. And if people were willing to finance you longer duration, that speaks to your credit worthiness. If no one's willing to finance you over a longer duration, they're like, dude, you got 90 days before, like, I don't trust you that much. Well, that speaks to how credit worthy you are. Okay, so that's his first point. His second point is the sensitivity to rates. So these T-bills, they don't use the Fed funds rate, but think of it this way. Let's say T-bill rate is, I'm just picking numbers out of my butt, but just bear with me for the sake of example. Let's say the T-bill rate is 3.5%, okay? And let's say the Fed is, man, there's inflation out the wazoo. We need to raise rates to 4%. But by raising rates to 4%, why would anybody buy T-bills if they can get higher rate at the overnight window? Right? The Fed's giving you 4%. Why would I buy a T-bill at 3.5%? So then the U.S. government has no ability to raise money using T-bills because the Fed is paying more.
The Treasury does not need to stand up and announce that it is launching another round of quantitative easing for the market to experience the consequences of easier financial conditions. If policymakers are increasingly compelled to support the long end of the bond market because higher yields are becoming too expensive for a government carrying tens of trillions of dollars of debt, then the system itself begins to create pressure for lower yields and greater liquidity. The terminology can change, the mechanics can change, and the institutions involved can change. But the direction of travel is what investors need to watch. There is also a much deeper problem sitting underneath the buyback discussion. As Mallers explains, replacing longer-term financing with increasingly large amounts of short-term Treasury bills makes the government more sensitive to changes in interest rates. A 30-year bond locks in financing for decades, whereas a 3-month Treasury bill has to be continually refinanced. If short-term rates rise, the government's financing costs can rise rapidly as that debt rolls over. And that creates an uncomfortable feedback loop. Higher rates increase interest expense. Higher interest expense increases deficits. Larger deficits require more borrowing. And greater borrowing can put even more pressure on the bond market. This is why the Treasury's actions deserve so much attention from Bitcoin investors. The initial increase in long-duration Treasury purchases coincided with a sharp decline in yields and a powerful rebound across risk assets, while Bitcoin delivered a 20% plus 3-day surge and spot ETFs recorded their strongest weekly inflows in months. Now the possibility of using close to $1 trillion of the Treasury's cash balance to support further buybacks introduces an entirely different scale to the conversation. It does not guarantee that Bitcoin goes straight up, and it certainly does not eliminate the possibility of volatility, but it does reinforce the argument that the liquidity environment could be shifting at precisely the moment Bitcoin is regaining significant momentum. If that is the direction we're heading, then the rally we've just witnessed may not simply be another Bitcoin short squeeze. It could be the market beginning to price in a much larger liquidity cycle. If you enjoyed the video, make sure to like it, subscribe to the channel, share it with someone who needs to understand what's happening in the Treasury market. Thanks as always for watching, and I'll see you in the next video.